Jai Hind everyone. Welcome to my YouTube channel which is Explore Yourselves, Banking and General Knowledge, etc. Today I'm going to describe about cash transaction limits under the Income Tax Act 2025, important rules every taxpayer should know. Introduction. India is steadily moving towards a transparent and digitally driven financial system to discourage cash transactions, reduce tax evasion, and promote accountability. The Income Tax Act prescribes several restrictions on cash receipts, loans and repayments, business expenses, donations, and withdrawals. These provisions are designed to ensure that financial transactions leave a proper audit trail and comply with tax laws. Many taxpayers unknowingly violate these provisions simply because they are unaware of the applicable limits. In several cases, the penalties can be severe, extending up to 100% of the amount involved in the transaction. Therefore, whether you are an individual, business owner, professional, charitable institution, or property buyer, understanding these transaction limits is essential. The following guide explains the major cash transaction limits under the Income Tax Act in a simpler and structured manner. Receipt limit. Section 269 ST. One of the most important provisions under the Income Tax Act is Section 269 ST, which restricts the receipt of large sums of money in cash. Under this section, no person can receive rupees 2 lakh or more in cash from another person in a single day for a single transaction or for transactions relating to one event or occasion. This means that even if the payment is split into multiple installments on the same day or for the same transaction, the restriction still applies. For example, if a customer purchases goods worth rupees 2.5 lakh and pays the amount in cash, the transaction violates Section 269 ST. The law aims to discourage high value cash dealings and encourage digital or banking channels for such payments. The penalty for violating Section 269 ST can be equal to the amount of cash received unless the receipt can prove that there was a genuine and reasonable cause for accepting the cash. Second, cash loan deposit and specified advance limit, Section 269 SS. Section 269 SS prohibits accepting loans, deposits, or specified advances of rupees 20,000 or more in cash. If any person accepts a loan, deposit, or advancing related to the transfer of immovable property amounting to rupees 20,000 or above, the transaction must be carried out through banking channels such as account payee check, bank draft, electronic clearing system (ECS), other prescribed digital payment methods. The provision has been introduced to prevent the circulation of unaccounted money through informal cash lending. Penalty. Violation of Section 269 may attract a penalty equal to 100% of the amount accepted in cash under Section 271D. Third, cash repayment of loan or deposit, Section 269T. Just as accepting loans in cash is restricted, repaying them in cash is also regulated under Section 269T. No person should repay a loan or deposit of rupees 20,000 or more in cash. The repayment must be made through proper banking channels. This provision applies to repayment of loans, deposits, specified advances. The objective is to maintain transparency in financial transactions and prevent manipulation of cash records. Penalty. Violation may result in a penalty equal to 100% of the amount repaid in cash under Section 271E. Fourth, business expense paid in cash. Section 40A3. Businesses often incur day-to-day expenses. However, Section 40A3 restricts cash payments made towards business expenditure. If a business makes a cash payment exceeding rupees 10,000 in a single day to a single person, such expenditure generally will not be allowed as a deduction while computing taxable income. This provision encourages businesses to make payments through banking channels, ensuring better accounting, reducing tax evasion. Exception for transporters. For payments made to operators engaged in business of flying, hiring, or leasing goods carriages, the permissible cash payment limit is rupees 35,000 per day per person. Any payment beyond the prescribed limit may lead to a disallowance of the expenditure under the Income Tax Act. Fifth, cash donation limit, Section 80G. Taxpayers often make donations to charitable institutions, claim deductions under Section 80G. However, donations made in cash are eligible for deduction only up to rupees 2,000. If the donation exceeds rupees 2000 and is made in cash, the donor cannot claim any deduction under Section 80G. To claim tax benefits for larger donations, payments should be made through banking or digital modes. Sixth, cash withdrawal from bank. Many people believe there is a legal restriction on withdrawing cash from their own bank account. In reality, there is generally no direct restriction on cash withdrawal from one's own bank account. However, large cash withdrawals are monitored and reported by banks to the income tax department as part of regulatory reporting requirements. Therefore, taxpayers should maintain proper records, preserve supporting documents, be able to explain the purpose and utilization of substantial cash withdrawals if required during assessment or inquiry. Maintaining adequate documentation helps establish the legitimacy of the transaction. 7. TDS on cash withdrawal. To discourage excessive cash transactions, the Income Tax Act provides for deduction of tax at source (TDS) on cash withdrawals exceeding specified limits. The applicable thresholds are rupees 1 crore aggregate cash withdrawal during a financial year for most taxpayers, rupees 3 crore aggregate cash withdrawal during a financial year for cooperative societies. TDS rate where applicable 2% TDS if the PAN is valid and operative, 20% TDS if the PAN is inoperative. Although TDS is deducted at the time of withdrawal, eligible taxpayers may claim credit while filing their income tax return, subject to applicable provisions. 8. Property transactions in cash. Real estate transactions are closely monitored under the Income Tax Act. Accepting or paying substantial amounts in cash while buying or selling immovable property may attract the transaction provisions of sections 269SS and 269SC, depending on the nature of the transaction. Apart from income tax implications, such transactions may also invite scrutiny from tax authorities and could result in significant penalties. Therefore, property transactions should initially be completed through banking channels to maintain complete legal and financial transparency. Ninth, splitting cash transactions does not avoid the law. A common misconception among taxpayers is that a large payment can be divided into several smaller payments to avoid legal restrictions. However, merely splitting a transaction into multiple cash payments for the same person, same transaction, or same event does not circumvent the provisions of the income tax. Tax authorities consider the substance of the transaction rather than just its form. Artificially splitting payments may still amount to a violation of the overall transaction exceeds the prescribed limits. 10th, penalties can be extremely severe. The Income Tax Act prescribes stringent penalties for non-compliance with cash transaction provisions. Violations involving Section 469SS, 269ST, 269T can, in certain cases, attract penalties equal to 100% of the transaction amount. For example, illegal acceptance of a cash loan may result in a penalty equal to the loan amount. Illegal repayment in cash may attract an equivalent penalty. Illegal receipt of cash exceeding prescribed limits may also invite a penalty equal to the amount received. Therefore, taxpayers should exercise due care before undertaking any significant cash transaction. Best practices to stay compliant. To avoid unnecessary penalties and maintain compliance with tax laws, taxpayers should prefer banking channels or digital payment modes for high value transactions. Avoid accepting or making large cash payments beyond prescribed limits. Maintain proper books of accounts and documentary evidence. Preserve receipts, invoices, bank statements, and payment records. Consult a chartered accountant or tax professional whenever in doubt regarding large financial transactions. Regularly review changes in tax laws and CBDT notifications. Conclusion. Cash transactions continue to play a role in day to day life, but the Income Tax Act places clear restrictions on high value cash dealings to promote transparency, accountability, and the use of formal banking systems. Understanding provisions relating to cash receipts, loans, repayments, business expenses, donations, withdrawals, and property transactions is essential for every taxpayer. Compliance with these provisions not only helps avoid heavy penalties but also strengthens financial discipline and ensures smoother tax assessments. Whenever a transaction involves substantial amounts, using banking or digital payment methods remains the safest and most compliant approach. Disclaimer: this article is intended solely for general educational and informational purposes and is based on the provisions of the Income Tax Act, relevant rules, and publicly available government guidance as generally applicable. Tax laws are subject to amendments, notifications, judicial interpretations, and circulars issued from time to time. The information presented here should not be construed as legal advice, legal tax, or financial advice. Readers are advised to refer to the latest provisions of the Income Tax Act, notifications issued by the Central Board of Direct Taxes (CBDT), and consult a qualified tax a chartered accountant or tax professional before making any financial or tax-related decision. The author shall not be responsible for any loss or consequences arising from reliance on this information. Thank you very much for your patience. Please like and share this video and subscribe to my YouTube channel.